Okay, I'll make a start. I think there's probably a lot of people delayed this morning and cold, so yeah, we'll crack on. Yep, so we're going to talk about alternatives today. The question is, can alternatives deliver when it counts? So what do I mean by this? I think after several years of what can be perhaps fairly described as mediocre performance by hedge funds and other alternatives over the last few years, especially when we compare them versus broader traditional asset classes. I think it's a fair criticism that people can ask, why would I even have included alternatives in my portfolio over the last 10 years? And actually, probably the answer is that we shouldn't when we look at what equity markets have done. But I think as, we potentially move into a more volatile market environment and we think about how we navigate those markets. This is, I think, when alternatives really need to step up to the plate, and we need to be thinking about how we can utilize them to make sure we can use them to enhance our clients' portfolios and help us deliver some strong returns. So in pursuit of this, we'll discuss recent hedge fund activity, what different strategies have been doing to cope with recent volatility and also to profit from it. We'll talk about the performance and profile of the L&C UCITS model and the other hedge funds that we utilize, and then also we're going to talk a little bit about alternative income and introduce a new element to that we're going to be rolling out in the near future. How does this work? There we go. Okay, so a little check-in on how the hedge fund industry is performing. On the right-hand side here, we have the total hedge fund industry assets globally. It's split out by the four broad areas of hedge fund strategies, being relative value, macro, event-driven, and equity hedge, or long-short equity is also known as. And we can see that actually growth has been quite steady now over the last 5 or 6 quarters after a bit of a soft patch through 2016. And this growth has really been driven both by strong performance. So 2017 was a pretty good year for hedge funds, and also a return to positive flows. So in 2016 it was a little bit of as I said, a soft patch. Performance was weak, especially versus traditional assets, and we did see some outflows from the industry. There were quite a few large well-known funds that performed poorly, and there was, if you like, an exodus of investors from those funds, which meant there was quite significant flows at the industry level on the negative side. So we've bounced back to growth now. There's some moderate inflows, and I think the industry is looking relatively healthy. Everything that we're hearing from institutions and other family office type investors that we see in various surveys point to them actually looking to further increase and bolster their alternatives allocations in the coming couple of years. I hadn't looked at this long-term performance chart for a few months, and when I pulled it up, I thought it was it was very interesting. The fact that the hedge fund index line, the HFRI, which is this blue line, and the S&P, which is the purple line, have actually now coincided. So I thought it was an interesting point to actually look at this. So we've actually had this divergence which really started at the beginning of the bear market in the early 2000s. So we've had this kind of 18-year divergence, if you will, and the S&P has now quite resoundingly caught up with this particular hedge fund index, and now looks like it's overtaking. So I think part of a couple of points I want to make here is that they've both got to the same point over that time, but they've done it in a very different way. And that's actually why hedge funds can be beneficial, because when you combine the two things together, what you get is something that's a little bit different. You would have, would provide a smoother path if you like, by combining those two things together. And the other thing to point out, as I think we always do when we show this chart, is that, you know, part of the reason for holding hedge funds is the periods of outperformance that you see in the downside for markets. So especially in this initial period here, where you see a flat performance versus a declining equity market, and then over time you will see that the downdrafts are a little bit more subdued versus the equity market, but you do often miss out on these strong rallying, you know, bullish periods for traditional asset markets. So there's no significance to this point. It doesn't actually mean that the S&P goes back down. It just so happened I thought it was an interesting time to look at that, you know, and I think it's a good reminder as to why equities and hedge funds can do different things, and why we can combining them together makes good sense. So we'll look at what some of the hedge fund guys have been doing. We'll first of all look at the equity hedge funds. So this is typically long-short hedge funds that are in the equity market and taking both long bets on stocks they think are going to rise and short bets on stocks they think will fall. And we're going to look at what activity, we're looking at what their activity has meant for their long-short ratio in the last sort of 5 or 6 months. So we think of this ratio, this yellow line, as how many longs or the value of longs that they're holding versus the number of shorts or the value of the shorts that they're holding. And you can see that actually through this bullish period it was rising moderately anyway, and hedge funds were feeling quite bullish about things. But the interesting thing is that when we started to see this sell-off in markets, this ratio actually rose quite rapidly. Now obviously there's two sides to this story. One is that there was some short covering, so that means where shorts had been performing very well when the market sold off, hedge funds actually bought back those stocks and reduced those short bets. And then the other side of it is actually that they would have been adding to their longs. So where there was an equity sell-off, where they felt there was some fundamental value, they've been buying quite aggressively into that market sell-off. So actually we're now at a near-term peak, if you will, and hedge funds are looking quite, some of the equity hedge funds, this is actually in the States, are looking pretty bullish again, given the recent shakeout in markets. So that gives us a signal as to how some of the fundamental guys are thinking about things. And when we talk to some of our funds, we are hearing the same thing actually. They've taken a couple of them have taken opportunity to buy into this. We have others that are just more conservative in nature and they've not really changed what they do, and we wouldn't expect them to either. Now we're coming on now to the CTAs. CTA stands for Commodity Trading Advisor, or we can also think of them as trend followers. They follow the trends in markets. So we're going to talk about their activity over the last month or so. So CTAs are, if you like, computer or algorithm-driven strategies. They trade across various different asset classes, so equities, fixed income, FX and commodities, all in the futures markets. So we have a couple of CTAs, Winton, in our portfolio, and another shorter-term CTA that's called Conquest. So this shows actually how the funds CTAs were broadly positioned in the equity markets. These are various different global equity markets at the recent market peak on January the 26th. This is a naive model provided by Societe Generale. They actually show what they predict these medium-term trend followers would be doing. And we'll go into the detail of how they actually ascertain that in a second. But you would be probably been blind over the last couple of years to notice that the trend in equities has been very much upwards, and so it makes sense to be long of all these markets. In some cases, the time that you would have been long has been almost 2 years. So in the Dow Jones, almost 2 years, it would have made sense to hold a long position. just hold on to it blindly and ride that wave upwards. And that's certainly what some of these medium-term trend followers have been doing. In January, up until the 26th, that would have been very profitable. So this portfolio of equity positions would have made a nice 5% return for this particular, for this section of a fund. So how are they actually looking at this? So we'll break this down. So the red line is the Euro Stoxx 50. And that shows the price evolution over time over the last year. And then we're looking at a fast-moving average and a slow-moving average. So the fast-moving average is the black line, and this is how the price change, the 10-day moving average of the price change, and the purple line is the 100-day moving average of the price. So you can see that the black line moves around a little bit more quickly. The purple line moves a bit more slowly. And then these pink blocks that you have would indicate whether you would actually be long, which is when it's above, if you like, above the middle line, or whether you would be short and you would be selling that market if it's below the line. So how is that ascertained? Well, essentially, if this black line is above the purple line, that indicates that the momentum is upwards, that the market is drifting upwards, and therefore you should be buying. If it drifts below the line, so here you see it crossing the purple line to the bottom, that would indicate that the momentum is going down and you should actually be short of that market. So you can see that sometimes this can change quite rapidly. You would be short and then you would actually go back long again. That's probably not going to make you any money because you got short, but then the market switched and you should have gone long, and actually you're getting chopped around a little bit. So what we can see here after a period of a few months of being long of Euro Stoxx as the market was rising, when the market fell, eventually this 10-day average moving average line moved quickly below the purple line, and this would be a signal to sell this particular market. So we can see then that you would have a short position in this market. And so this is what has happened quite recently in Euro Stoxx. A little bit different in the S&P. Actually, this black line remains firmly above the purple line. It wouldn't indicate that you should go short of the S&P, but it perhaps would indicate, if you were sophisticated, you'd think, well, there's been a pullback here, so I'm going to perhaps reduce my long position in the S&P. So you perhaps pull back the risk that you hold in that particular future, in the S&P mini future that you would be trading in this instance. So this is kind of some of the ways that the computer algorithms think or are programmed to think about the markets. So what does that mean come the end of last week, around this, I think it's Thursday of last week, that actually, yes, we still have quite a lot of long positions in the global stock market, but now you also have quite a lot of short positions if you were a naive trend following strategy, as defined here by this model provided by SocGen. So what you could argue now is that this global equity exposure is now a lot more balanced. They're not CTA hedge funds, trend following hedge funds aren't just very long the market and perhaps pushing that trend and extending it too far. What we find now is that this is more balanced. These short positions have now only been in place for a few days, a week to 2 weeks, and actually it's probably again been a little bit painful because they've probably gone short into some of these markets just as the market is now starting to recover again. But I think it just highlights some of the dynamic nature in the way that these strategies operate. But you can see that coming into February with a lot of long positions has been very painful. So that would have been this portfolio would have lost 5.75% month to date, and would actually be negative on a year-to-date basis as well. We're going to look at the same thing in the bond market. So this is the government bond futures market, and actually there hasn't really been much change between January 26th, the market peak of equities, and just as last week, February 22nd, when I ran this. So we could see that a naive trend-following strategy would still be short very much of the government bond markets, and actually it's been quite profitable in both months, both in January and in February, and on a year-to-date basis, this would have made quite a bit of money for the CTAs. So I think this highlights a couple of things that CTAs can, for instance, can generate profits from different market events such as yields selling off. They can sometimes contribute to that, actually exacerbate that issue as they actually jump on that trend and actually become a little bit more extended in that positioning. And we can actually see here that the trend in the US 10-year. So this again is the fast-moving average, has actually been, it was actually accelerating up until this point, and very much, I think, driven by some of these algorithm-based hedge funds that were jumping on this trend and have been shorting, not just the US 10-year, but various different government bond markets globally. And therefore, as indicated by the pink block below the line, this would have been a short position that they've been running for the last few months. Now, interestingly, we have seen some stabilization in yields in the last few days, and it may be that if we drift a little bit and we find a little bit of a range-bound market, we may actually see those trend lines, the black line and the purple line, start to come close to crossing again, and you may see that positioning starts to change. And so that's always something to watch, because when these strategies actually switch position, it can contribute to markets moving one way or another. Okay, so that's the CTA market. Now we're going to look at volatility and how hedge funds can perhaps look at volatility and benefit from what's going on in the volatility markets. We often look at this chart of the VIX, and hopefully you should all know by now that this is if you like, a fear gauge. It gives you an indication of the volatility or the expected volatility in the S&P through the options market. And we can see that recently there was a very large spike in the VIX. It had been some time. There'd actually been a long period of suppressed volatility all the way through 2017, and we saw this big spike over just a few day period. So if this genie's out of the bottle, how can we actually play the volatility curve? Well, I'm just taking you back a little bit in history here. I know it looks like I've basically given a toddler a bunch of crayons, but if you bear with me, what we've actually got here is the volatility curve going back 5 months prior to now. So we've got August, September, October, November, and December, and the bottom left-hand point of each curve is the VIX, and then each subsequent point on the curve is the next future going out on that line. So you can think of this as being like a yield curve, if you like, that predicts a futures yield curve that tells you what the expected future point of volatility will be at any one point in time. And you can see that this curve is very well behaved. It looks very, very similar month after month after month. And if we go further back in 2017, it continued to look like this. Now, this is a very benign period. We have a fund, Cassiopeia, that trades in volatility markets, and they will be trading futures along this curve. So they might be long of one point, short of another point. They might be long the future versus a market hedge, or short the future versus a market hedge. And they'll be looking to generate returns from this market. And they can do so. They can generate a few percent a year, and that's fine. We're quite happy with that. But what happened in the first week of February was this, and suddenly things got a lot different, a lot more interesting, and we had a big inversion of the VIX curve, completely flipped, and you saw that the front point, the VIX itself, actually spiked. I think at one point it rose to around 50, but here on the day it's around 30 or something like that, and then actually what you see is a completely different shape. So Cassiopeia, which is our volatility our relative value volatility trading fund, they were actually able to get long of these particular futures contracts here. They've hedged this out with some market exposure in the underlying S&P, and they were able to make 7 or 8% on the day on this particular. I think it was Monday, the 6th of February. So this just highlights, the volatility. We can talk about it spiking, increasing. It doesn't necessarily mean that much to us, but actually to some strategies within hedge funds, this can be a profitable opportunity. And these are the kind of opportunities we're going to be continuing to look at and continuing to include in our hedge fund selection to ensure that we can actually deliver some returns when these kinds of events occur. So what does the performance overall look like? We have we can see in the grey line how the London and Capital UCITS hedge fund selection has performed, and it's slightly down for February and still positive on a year-to-date basis, which is quite pleasing. We're certainly outperforming the index, which has suffered a little bit more and is marginally negative, but close to flat on a year-to-date basis. So, in broad terms, I think hedge funds are holding up, but we're certainly doing a little bit better than that, and I think I think we can be pleased. So what have we been looking at today in terms of the different strategies? Well, we've been looking at the CTAs, and yes, clearly we've had a very poor performance from the CTAs. Winton is still marginally positive on the year, but our shorter-term trend follower, Conquest, is actually negative on the year. It's the only one that's really significantly negative. We have a slight negative performance on the year from Marshall Wace, which is an equity-based strategy. But everybody else is actually performing pleasingly quite well. Cassiopeia, as I mentioned, they're up just under 5% for the month. So they've been a big driver of returns for us in February. So how are we actually achieving these returns? Well, the portfolio is designed to contain very low correlation elements, such that the L&C UCITS portfolio as a whole actually comes out with a very low correlation versus the market. So what we have here is a correlation matrix. We have each of the main markets here: S&P, MSCI World, and then a couple of hedge fund benchmarks, the L&C UCITS solution, and then we have the 10 underlying constituents. And so each point here tells you the cross correlation of each one. So the main things to look at here is the correlation of the L&C UCITS basket, which actually is pretty close to zero, if not slightly negative, versus the market and versus hedge funds as well. So we're very pleased that we're able to produce a positive return whilst being slightly negatively correlated versus the market and the benchmarks. And when we look here, MSCI World and S&P versus these underlying constituents, we don't really see anything that worries us too much. We have one red point, which is EMSO, an emerging market debt fund that has a high correlation to the MSCI World. But actually, this isn't overly concerning. I think it's a little bit erroneous that a debt fund has this kind of correlation, and actually we know that they're quite conservatively positioned. So I think we can be quite pleased that what we have here is a good basket of funds that are exhibiting good correlation statistics. How have the offshore hedge funds been getting on? It's been a similar story. That performance has been reasonable until now, and actually the benchmarks have been performing very, very well, and we've been almost struggling to keep up, especially with the Bloomberg hedge fund index, which is quite aggressive. I think it's got a lot of beta in that index, but what we've certainly seen this month is that we're very slightly negative over the month. The indexes have dropped more substantially. So I think we're doing a reasonable job there. Just as a reminder, the high conviction hedge fund list, it's very similar to the UCITS, but it actually contains a few different elements. for professional clients that can enter into offshore funds. So we've got some strategies in tech, in biotech, and in commodities, agriculture, and power markets as well. So this selection does tend to perform a bit more aggressively, if you like. It moves around a lot more than the UCITS hedge fund model. Hence, it's only really for professional clients that can add these strategies into their portfolios. Okay, so now I want to move on and talk about a new listed alternative income idea that we're adding into the alternative income selection. SQN is a asset finance. It's called the Asset Finance Income Fund. It is a closed-end fund, and it's listed on the London Stock Exchange. I think in the specialised fund listing section of the LSE. And this strategy is involved in financing and leasing to a diversified set of businesses. So you can think of this, if you like, as it's a form of credit. It's a form of asset-backed lending, actually leasing business essential assets for businesses to be able to operate and repay those leases. So what kind of assets are they targeting? Business essential assets, so assets that are utilized by a broad array of industries. Revenue producing assets that can obviously be profitable and produce the cash that's needed to pay back the leases, that they have a high value, that they have a long economic life and they're not going to deteriorate in value, and that they have active secondary markets or multiple industry applications. And the avoided assets is actually very much the opposite of that. So what do they actually lend to, and what does the portfolio look like? It's very, very diversified, as you can see. The biggest constituent here is actually anaerobic digestion. So this is energy being produced by anaerobic digestion, and that actually has some government-backed subsidies, which make this this industry has some very stable cash flows. We have manufacturing equipment. We have vessels. Actually, in the case of vessels, we're looking at some small cargo ships that are transporting goods and commodities around the world. What else have we got in there? We've got waste processing, aviation equipment, some wind turbines. So there's all sorts of things that are going on in this portfolio of assets that's generating a really healthy yield. So the weighted average yield is 9.68%. This is actually an unlevered yield, and this allows this company to pay out a 7.25p dividend annually. They actually, although they actually pay it on a monthly basis. It has an average investment size of £7.1 million and a market cap of 460 million, and a weighted average remaining term on the lease of the leases of 6.4 years. So we think that this is a good addition to the alternative income basket. This is what it now looks like. So if we SQN is here, we have 4 funds that can be accessed more by, if you like, professional or qualified investors with various different strategies. So we have private lending, receivables financing, insurance-linked securities, and hedge fund trader financing. Amadeo, you may recall, we've discussed in the past, and that is aircraft leasing. And that is a listed entity which is now held broadly by many of our clients. So with SQN, we have another edition that's now listed. It's actually going to be broadly available to the whole of the client base. There shouldn't be any restrictions in terms of who can actually hold this, and therefore people can start utilizing it to add to their alternative income allocation, if you will. Okay, so just coming back to the question at the beginning, can alternatives deliver, and why should we be using them? So we've talked about hedge funds, we've talked about alternative income. what should we be trying to achieve with them? Well, look, we're looking here for some alternative sources of return, whether it be trading, trading the trends as CTAs do, whether it be more fundamental guys like the equity long short that we discussed, or whether it be trading volatility, or indeed SQN, who's leasing business equipment to companies and trying to generate a steady return. These are different elements, different sources of income that we're trying to bring in for our clients, which we hope should have low correlation to bonds and equities. So the purpose of this is to be able to try and enhance the profile of a traditional asset portfolio. So what that means is, I know this is it's a little bit theoretical looking for those of you that have looked at portfolio theory. We've got expected risk here and expected return. By adding in these assets, we should either be able to enhance our return for the same level of risk, or we can actually produce the same level of return but do it with lower risk, or a combination of the two. So by utilizing this, we should be providing a better return profile for our clients, and that's the intention. And I believe that alternatives can deliver this as we move forward. Okay, so just to summarize, the hedge fund exposures have been very dynamic recently. It's been in a state of flux as they are adapting to the market, and we're seeing volatility emerge. We're seeing strategies, do different things to be able to profit from that, and also to navigate these more volatile times. Esoteric strategies such as Cassiopeia can actually provide us with strong returns. So it's not just about, navigating and getting through it. It's also about, can we take advantage of some of these movements, and alternative income, if you like, is also providing us a steady source of return that's not impacted at all by this market volatility. Most of these strategies have been very steady and have not been impacted by what's been going on in the broader markets. So yeah, we think that the alternatives allocation can deliver a steady and uncorrelated return for our clients. And just another note, we've been talking here about hedge funds, we've been talking about alternative income. One area we don't cover a lot is private equity. And some of you may know that Jamie will be helping going forward in terms of private equity. Initially covering exposure that we have among our client base at the moment, but I think over time we'll carefully consider what we can do in private equity, what kind of solutions we can offer to our client base. It will be a slow-going project in terms of, we're certainly not in any rush. We'll be thinking about when the best timing for that kind of thing will be, but you can expect us to start introducing more elements of this into IDB and what we discuss in coming months. So that's it, relatively short and sweet. Let me know if you've got any questions.